Today is the day the global market officially priced in India's transition from a fragile emerging market to a global manufacturing superpower. While we were sleeping, the father of all deals was signed between New Delhi and Washington, D.C. And this isn't just a trade agreement, it's a total realignment of the world order. If you opened your trading terminal the February 3rd, you probably thought there was a glitch in the system. You probably refreshed your screen 5 times, checked your internet connection, and called your broker. The Nifty 50 didn't just open green, it performed a 1,100 point vertical leap. We are talking about the single largest gap up in the history of Indian stock market. Think about that for a second. We've seen rallies, we've seen post-election jumps, but what we have never seen is that the entire market repriced itself by nearly 5% in a single heartbeat. The Sensex followed suit, exploding by over 4,200 points in the first few seconds of the trade. But why? Is it just a relief rally because the budget is over? Obviously no. The markets don't jump 1,100 points. They jumped on a fundamental issue or when the terminal value of an entire nation changes overnight. And the biggest reason for that was the US and India trade deal finalization. In today's masterclass, we are going to perform a forensic audit of this deal. We will talk about the massive give and take, how India sacrificed Russian oil to gain American market dominance. We will connect the dots between the deal and the 17.2 lakh crore budget we just saw 48 hours ago. And most importantly, we'll talk about the EU-India pincer move, a strategic masterstroke that makes this momentum truly dangerous for our competitors like China and Vietnam. But obviously, we must stay alert. Har chamakti cheez sona nahi hoti. So while Nifty is celebrating, the bond market is screaming a warning. We have a lot of data to crunch. To understand why your portfolio is up today, you have to understand the grand bargain finalized between President Trump and PM Modi. This deal isn't built on handshakes. It's built on 3 massive pillars, 3 cold-blooded pillars. Pillar 1 is the 18% tariff revolution. For the last year, Indian exporters were being choked. We were facing an effective tariff of 50% in the US. So let's break that 50% down. 25% was basic reciprocal tax applied to countries with high trade surpluses. And another 25% was a geopolitical penalty. That tariff has been slashed from 50% to a flat 18%. Look at the map of our competitors. China is facing a crushing 47% tariff. Vietnam is sitting at 20%. Mexico is struggling with labor disputes, and at 18%, India is now officially the most cost-competitive factory for the American consumer. If you're an American CEO looking for your 2026 supply chain, you aren't looking at Shenzhen anymore. You're looking at Gujarat, Tamil Nadu, and Uttar Pradesh. Pillar 2, the Russian divorce. This is the part that hurts, and we have to be honest about it. The US didn't give us 18% out of the goodness of their hearts. This was a trade-off. In return for market access, India has reportedly agreed to halt all future purchases of Russian crude oil. Since 2022, Russia was our discounted fuel station. We were saving billions of dollars in foreign exchange by buying Urals at $10 to $15 discount. By walking away from that, India is taking a massive short-term hit into its import bill. Government has calculated that permanent market access to the $25 trillion economy is much bigger price than a temporary discount on oil. दोस्ती अब धंधे में बदल चुकी है. We chose the future of our exports over the savings on our fuel. And the last pillar, number 3, the $500 billion Buy American commitment. India hasn't just promised to sell, we have promised to buy. We have committed to sourcing $500 billion worth of American LNG, coal, and technology over the next 5 years. This isn't just a trade deal, it's a geopolitical marriage. We are intertwining our energy security with American production. By doing this, we make it impossible for the US to decouple from India in the future. We aren't just a trade partner, we are their biggest customer as well. Why did the Nifty react so violently? Because the market realized that the budget 2026, which everyone called boring just 2 days ago, and even we were struggling by creating 3 new versions and research reports, was actually the silent launchpad for this US deal. The finance minister knew this deal was coming. Every rupee allocated in the budget was a preparation for today, as it seems right now. The FM allocated a record amount to capital expenditure. Think about the scale. If you are going to handle a $500 billion in new trade, Your current ports will choke. Your roads will crumble. Budget 2026 isn't just building roads, it's building the logistics, plumbing required to make the US trade deal work. We are talking about dedicated freight corridors and smart ports that can process a container in hours, if not days. There is a specific high-level clause in this deal called Pax Silica. The US wants a trusted foundry, a place to build chips that isn't under the shadow of potential conflict in the Taiwan Strait. The budget focuses on Semiconductor Mission 2.0 and it provides massive subsidies, and the US deal provides the technology transfer from giants like Intel and Micron. This is how India moves from just assembling iPhones to manufacturing the core intellectual property. The budget simplified the tax code and introduced a new income tax act. Why now? Because if a US company wants to move 50,000 employee factory from Shenzhen to Noida, they don't want to deal with tax terrorism or 1960s era litigation. The budget gave them the map, the trade deal gave them the fuel. And here is the interesting part. If you think this is just US-India story, you are missing on the bigger picture. The smart monies, the FIIs who are pumping billions into the market today are looking at a pincer move. Last week, almost quietly, India signed the EU-India Free Trade Agreement. We have covered that in a separate video. India has pulled off a masterclass in trade diplomacy. For 30 years, we struggled to sign one major FTA. And in the last 14 days, we have secured favorable terms with the US and the EU simultaneously. If you are a global corporation and you set up a factory in India today, you get 0% tariff access to the European Union, the lowest 18% tariff access to the United States. It's called a win-win. European companies excel at high-end machinery and R&D. American companies excel at scale, marketing, and consumer technologies. India is the only neutral ground, the only platform where these two can meet, and this is what we call a double-engine growth model. No other country, not Vietnam, not Mexico, has this kind of double access. This is why the China Plus One strategy has officially become the India-only strategy. But let's calm down a little bit. Let's take a breath. I know your portfolio is green and the headlines are celebratory. But as your resident's reality check, you have to look at the dark side as well. Market don't go up in a straight line forever, and there are 3 landmines we need to watch about. Landmine number 1, the bond market alarm. The 10-year GSEC yield has hit 6.78%. To fund a 17.2 lakh crore budget and build all this infrastructure, the government has to borrow a lot. When government borrows more, the bond prices fall and yields rise. High yields are poison for bank margins. This is why Bank Nifty is lagging. If yields hit 7%, the cost of capital for every company in India goes up and the market fatigue will begin. Landmine number 2, the oil inflation risk. By divorcing Russian oil, we are now at the mercy of Brent crude market. We are back to buying oil at market rates. If there is a supply shock in the Middle East, our current account deficit will explode. The rupee could come under pressure, and what the market gained in trade might lose in currency depreciation. And the landmine number 3, the agricultural red line. This is the political X factor. The US wants zero tariff on their dairy, wheat, and apples. India has millions of farmers who survive on price protections. If the government allows American milk and poultry to flood our markets to keep US happy, we could see some massive social unrest. This is the biggest risk to the grand bargain and the domestic political cost. So what is the bottom line? Today's 1,100 point jump is a stamp of approval from the world. India has finally broken the trade barriers that has held us back since 1990s. My strategy for you: focus on export first companies. Look at electronics, auto components, and high-end textiles. They are immediate winners of this 18% tariff. Do not go all in on banks until the 10-year yield stabilizes. And the last one is a 1,100 point gap is massive. Historically, the markets like to come back and test these levels. Don't let FOMO make you buy the top. Wait for the settling phase. Also remember a fundamental truth. India's golden era has begun, and we only need to deliver on this. But it will be a volatile ride for some time. Make sure you subscribe and hit that notification bell, because tomorrow we are going to do a deep dive on bond yield versus bank profit crisis. You cannot afford to miss that technical autopsy. So stay smart, stay grounded, and I will see you in the next one. Thank you for tuning in.